Ladies and gentlemen, can I have your attention, please? Good afternoon to you all, and welcome to today's event, which is really exciting for us. For those who don't know me, I'm Dickie, Whitaker, and I'm CEO of Oasis. I'm really pleased to be able to introduce our speakers in a second. Before I do that, a little bit of housekeeping. So this is the agenda you can see on the screen behind you. So after I've done a little bit of introduction to the day, we're going to have Kirsten Mitchell-Wallace and we're going to have Chen speaking a little bit about some context from Lloyd's. We're then going to have Steve White, who's going to talk a little bit about some of the history behind pricing. There's some stairs up there, that's probably going to be your best. But actually, there's 2 seats at the front too. There's 2 at the front and 1 there, and stairs. Take your pick. And Steve's going to be talking a little bit of a perspective from his background, and I'll do a little bit more intro there. Then a little bit more property focus from Steve, and then the other Steve, Mildenhall, who wrote a book, which, as I said to him the other day, I have this book around with me occasionally. It's behind my home office to give me some street cred. I tried reading it and I failed. However, most of you in the audience have much greater expertise than me, and I'm sure you'll be able to get more out of this than anything else. And I think I should say, actually, whilst we are trying to champion some a bit of history about some pricing techniques overall, we're also trying to look at some new techniques, but we are going to be focusing on what practically makes sense. And the panel, which you can see coming up after the coffee break, if you leave at the coffee break to go back and redo your business plan, that's okay. But if you stay, you'll find out how to apply this more practically. And we've got some panelists that's been moderated by Paul Shedden, who some of you may know, a few things, including Catlin and Sompo and a few other places. And the panelists have been volunteered, or they volunteered, I should say, not because they're experts in pricing theory. Deliberately, they've been chosen or volunteered because they can represent the sort of average pricing actuary. I'm not saying they're average, by the way. I shouldn't use the word average. A bunch of actuaries. There's a full distribution of competencies, but they're not trying to be expertise. They're trying to be practical behind how we use this, and that's what we hope we're going to get for some of these questions. I do need to say, and this is important, that we, being Oasis, and of course anybody else that's sort of everybody else in this room, frankly, take anti-competitive practices and antitrust very seriously. We have a policy on our website, which you can go to if you like. We're going to be talking about today the methodologies and practical applications that can be used around pricing primarily, or any questions you have thereof. We're not going to be talking about sort of things that might relate to specific pricing issues relating to any line of business or anything else, because that would be inappropriate. And I would be making sure, as sort of master of ceremonies, that we don't stray into that area. I'm sure we won't. But if anybody thinks, by the way, that we're getting close, just raise your hand, let me know. Let me know somehow or other, and we'll make sure we address it. But it shouldn't happen, but we are paying attention. I want 2 slides very quickly on what Oasis is, because this is an audience that's a little bit more broader than some before. So Oasis is a not-for-profit company. It's open source. It has open source software that helps you understand catastrophic risk, and it means you can put a whole bunch of models into Oasis from any provider. Frankly, it can be your own models. It can come from specialist firms. It can come from academia. We're working with climate models where we're doing a whole bunch of different things. And then we curate a bunch of open standards as well, which create efficiency. But we have another role, I suppose, which is to try and stimulate innovation. And I think this is where this event today really comes into that. It's a bit more about innovation and possibly about efficiency, actually. I think we'll see. You can be the judge of that. Very importantly, Kirsten and Lisa are going to talk. I'm just going to leave those slides up there because it took me long enough to get them in the first place. Please, over to you.
That's fine, because we have our slides ourselves.
So thanks everyone. I'm not sure this is the most flattering camera angle. So thank you everyone for attending the session today. We're really delighted to be hosting this event here at Lloyd's and in person. And we hope it's going to be the first of many opportunities for members of the pricing community to get together and share our current thinking to solve problems in our industry. I'm Kirsten Mitchell-Wallace, and I'm Director of Portfolio Risk Management at Lloyd's. What is that? That's exposure management, aggregation, outwards reinsurance, pricing, portfolio analytics, and emerging risks. So a whole collection of quantitative things which sit within markets.
I'm Lisa Chen. I'm the head of pricing and portfolio analytics. Need to go and update my LinkedIn, just noticed.
So one of the few upsides of the recent miserable weather that we've been having is it's given me a great opportunity to listen to Steve Mildenhall and John Major's podcast, where they talked about their new book, Pricing Insurance Risk Theory and Practice. As a catastrophe modeler by training, what I find particularly interesting and what we're going to discuss today is recognizing just how far pricing capabilities have come since their origins. As we look back at the progress that's been made, it naturally also allows us to look forward to where pricing capabilities could be advanced to in the future. Our mission in my team, Portfolio Risk Management, is to create confidence to take risk. Confidence in pricing methodologies is a key ingredient in this. The challenges that our industry is currently facing around inflation, catastrophic events, and recent renewal challenges really highlight this purpose. Confidence in pricing gives us confidence to take risk.
Great. Before we dive into today's session, just wanted to say a couple of thank yous first up. So firstly, big thank you to the two Steves for the presentations we're about to give. I'm sure they're going to be hugely informative. Thanks also to our additional panelists, so Emma, Kian and Bernadette, who'll be joining us shortly, and Paul for moderating. I'm sure all of us are going to be very keen to hear what comes out of that panel discussion. And last but not least, big thank you to Dickie and to Matt and the team at Oasis, without which today really wouldn't have been possible. So please put your hands together and thank everybody who's given up their time to make today happen. Today's agenda covers the evolution of thinking around pricing for uncertainty over the last 40-odd years, I'd say. So I think it's appropriate for us to chip in briefly with some history from a Lloyd's perspective. Over the last 2 years, Lloyd's has stepped up our engagement with the market on pricing, first piloting and then meeting with all the syndicates in the market to evaluate pricing capability relative to the pricing maturity matrix and identifying areas for capability uplift. Whilst we don't advocate any specific methodology over another, we're obviously supportive of more effective, more sophisticated pricing techniques across both claims and non-claims cost components. When we're considering the application of pricing, we strongly encourage good links between pricing functions and underwriting, exposure management, capital, reinsurance, and reserving. In today's context of a fast-changing risk landscape, with challenges around the availability of capital and reinsurance and the resulting re-evaluation of risk appetites, pricing practitioners have a real role to play in integrating these dynamics in order to drive some joined-up decisions for carriers on a daily basis. Reflecting on the theme of today, time to update your pricing methodology, brings to mind a saying, the best time to plant a tree was 20 years ago. The next best time is today. So with that in mind, we're really pleased to be able to co-host the seminar as a forum to share knowledge, to encourage innovation, and also enable a discussion of the practicalities of actually trying to advance pricing methodologies within your respective organisations. I guess we'll now hand back to Dickie to introduce the first speaker.
Thank you very much.
Cheers.
Well, thank you, Dickie. Thank you, Lloyd's and everyone. Appreciate the opportunity to be here. I'm actually was an actuary by choice. I love it. I love the profession, and I really enjoy pricing and reinsurance. And I've spent almost my whole career in reinsurance. So hopefully, I have something of use to share with you. So I'm going to break it down into different segments. I kind of organized it by decade. It obviously doesn't work that way, but it did seem to feel kind of cleanly into these different groups. Before Hurricane Andrew, a major event that really rocked the insurance industry. Post Hurricane Andrew, what we tried to do to adjust. Post 9/11, it wasn't just 9/11 that drove that, but that was a convenient year 2000, 2001. the current state, and I'll allude to the future, but the future is the other Steve's presentation. So pre-Hurricane Andrew, things were a lot simpler then in a lot of ways. People had some theoretical ideas of what they should be doing. There were some papers, there were some methods, but really the tools and methods just weren't in play at the time. Tools that were used during that time, even though technically pre-90s predates my involvement in reinsurance, I've still seen plenty of these being used. Uncapped quota shares were used to manage CAT. You'd come up with the burning cost and load it with the target loss ratio. Target loss ratios were calculated with varying degrees of sophistication, quite often by a committee of senior underwriters. Heavy reliance on the concept of bank and payback. Some ways not that different. CAT models were crude by today's standards. The only one that I was familiar with or aware with at that time was just one where a U.S. hurricane had kind of some damage ratio estimates by landfall points spaced out, in 50-mile increments along the coast, and that was, our CAT model. Post Hurricane Andrew, again, I don't need to explain the significance of that to the industry, was really the beginning of the implementation of the CAT models. Now, fortunately, there were some forward-thinking people that had already started to develop the CAT models. AIR started in 87, RMS in 89, and EquiCat in 91. Few of us can remember the reinsurance world before these tools, and it's impossible to overstate the impact that they had on reinsurance pricing, especially when it came to property CAT. Post-Hurricane Andrew also involved some theoretical work. The first and probably the best known, maybe not the paper, but the formula is Rodney Krepp's reinsurer risk load paper, where you talk about the reluctance factor pricing or the standard deviation load. Premium is just mean loss plus the reluctance factor times standard deviation plus expenses. Obviously, that's simpler than is quite often used, but that's the concept. One of the things about it, rather than just loading your mean loss, before that everything was just mean, it actually included a measure of volatility and a consistent framework for doing some of the pricing, reflected automatically within the pricing framework that riskier business got a higher price, and that as you get more remote, so higher layers, that the relative value of the standard deviation or the CV increased as the mean decreased, and therefore the risk load became more significant. Weaknesses in that method, that reluctance factor is subjective. It can vary by region, peril, probability of attachment, underwriting cycle, but you use that to try to achieve your target ROE. Some of the other issues with it is it doesn't lend itself well to reinsurance allocation, and we'll talk more about that later. So if I priced each subset of the risk individually using the formula, so assuming that your expenses are additive and your mean losses are additive in order to achieve your premiums as being additive, that would assume that your standard deviation equals the sum of the individual subcomponent standard deviations. Well, if you remember your stats classes, the only time that happens is when you have perfect correlation, which we don't generally have that within our world. Some people will scale it, say sum up the individual standard deviations. In order to force it to the total standard deviation, they'll apply a constant factor to it, scaling factor. Well, one of the problems with that is it gives you the same diversification benefit regardless of the correlation or the attribution of the risk to the portfolio. It's a standalone pricing method. Contracts within a tower are priced independently and across risks. So there's no concept of portfolio management or tower pricing. The other problem with this formula is the lack of subadditivity. If I priced, my example is a 4 million x 1 million layer, and then I priced two layers, 1 million x 2 million and 3 million x 2 million, 1x1 and 3x2, in case I messed that up, you'll get a different price than you did for the 4x1. I mean, obviously you can adjust for that or compensate for that, but it doesn't automatically drop out of that formula. So another one of the papers that came out in that time was a paper by Sean Wang on his premium allocation paper. I'm killing the full reference, but there's an appendix at the end of this that has the actual reference of these papers. There were many formulas in there. The simplest one was the pH transform. The whole notion of the pH transform is you raise the survivor function to a power where that power is a function of the rho greater than 1, so the power is less than 1, which thickens that curve, and it gives you the difference in expectation from the original curve, and the transformed curve gives you your risk load. So just like the prior formula gives a measure, includes volatility in the risk, it provides a consistent framework. Higher layers are riskier relative than lower layers. One of the things that it addressed that the prior method lacked was the subadditivity issue. His layers will add up. And another benefit is it uses the full curve in the pricing rather than just a couple of the moments. Similar to the reluctance load, that rho is subjective, varies in the same ways as the other one did. Again, it doesn't easily lend itself to reinsurer cost allocation, and it's a standalone pricing. Within the layers, within a tower, it's consistent, but across towers, it's independent. Therefore, you have that whole portfolio management issue again. Comparing the two, I just did a quick example. I can share the spreadsheet if anyone wants to see it. But I priced a 4 million x 1 million layer, used Krebs risk load formula with a reluctance factor of 25%, calculated the risk premium, ignoring expenses. Then I used Sean's pH transform method to solve for his risk parameter to achieve the same risk premium as Krebs. And then I did each one of them in $1 million tranches just to show kind of the issues that I said. So if you see from this, I have the price of each one of them. Oh, I'm told I have a pointer. I'm break up the risk premium. And by risk premium, I just mean loss plus risk load. Expenses aren't in there. So if I do the total for Krebs and then I sum up the parts, they don't add up. The more remote you get, kind of bigger issue that becomes. If you do the risk premium with Wang's method, they do add up. The part that I thought was really interesting is how different of the loadings within the bands you would get between the two methods. So as you see, the one method, has kind of a steep increase in the curve, and if you continued with that same reluctance factor, as you went up, the price would get, continually get bigger, which is one of the reasons you'll see people varying that reluctance factor load as you get more remote from the loss. So you have the issue of subadditivity and what's really happening within it. Who's right? Well, I had an old wise underwriter tell me once upon a time, he's U.S., none of you would know him, but when I was concerned about my pricing on one deal, he said, just understand your price is wrong. Your hope is that it's wrong in the right direction more often than not. So which one of these methods are right? That's for you to figure out. So John Major, the other name on this book, and Rodney Krebs did a survey in 2001, published in 2002, to try to see how reinsurers were doing cap pricing at that point in time. And just a summary of the survey results, all are using cap models. Most use multiple cap models. A quarter of the respondents have proprietary in-house cap models. The majority of the underwriters have a walkaway price or minimum rate online. The majority we're using that reluctance factor load method, but they would tune, the reluctance factor to get their ROE by region peril. A few companies were attempting to assess the incremental impact a new contract would have to capital needed to support the overall portfolio. Marginal pricing, we call it nowadays. Most wish they could do this, but lack the analytical skills or brute force computing power to do it. Aggregation management at the peril and zone level, were common. The conclusion is the state of cat reinsurance as being in transition midway between the relatively unsophisticated old school approach driven by relationships and rules of thumb and a nearly visible ideal future where information technology drives risk quantification, liberating human creativity to add value to the client relationship. Seems like a pretty lofty aspiration that was given at that point in time. So again, 20 plus years ago. So after 9/11, and again, it's not all about 9/11, but right in that first decade of the 2000s, you had 9/11, you had the 2004, 2005 hurricane seasons in the U.S., and you also had a couple of earthquakes in minor non-peak peril zones that really rocked the world. And I think that was as a concern. I didn't do it. As the others, because no one really expected those to be, peak zones. They were, actually that's just diversifying my portfolio, having that New Zealand quake and having that Chilean quake. So those really rocked the capital foundation and therefore impacted the pricing going forward. So some of the methodologies that were previously discussed were now starting to be more commonly put into play. What are some of the risk measures to be used? What's the reinsurance cost allocation, marginal pricing, etc.? Capital models became more common, and probably most significant of all, computing power became cheaper and faster. So what you hadn't been able to do in the past, you could do going forward. So some of the ideas of risk measure. Now, actually, I like in Steve's talk, he talks about the original sources of a lot of these risk metrics and co-measures and things like that. I talk about the people who introduced it to me, which is heavily weighted to the people who I worked with at that time. So co-measure, it's one of these terms that get thrown around. Well, the co's just conditional, nothing magical about this. So how can I get a conditional expectation? A coherence risk measure, and forgive me, I'm grossly oversimplifying things when I break it all down, but the whole idea of a coherent risk measure is the parts add up to the whole. So if you look at the case of TVAR and co-TVAR, if I have a portfolio made up of a bunch of risks, X is the portfolio, X of I is the individual risks, I can calculate co-TVAR. So co-TVAR is the conditional of the individual piece, conditional on what the total is doing. And when I do that, if I calculate the TVAR on a standalone basis, it equals the sum of the co-TVARs across the pieces of the portfolio. That's actually really a major part of the whole concept of marginal pricing. How can I change my capital? How can I do other things? Some of the other coherent risk measures, this is not a complete list by any means. The paper I referred to by Gary Venter goes into much more, but TVAR, XTVAR, WinVAR is not a universal term, but it's basically the co-TVAR on a bracketed area. So if you're trying to do things with VAR, which is not a coherent risk measure, you can do the window or the VAR around a band around that VAR point and achieve the same kind of impact. Non-coherent risk measures, but we use them all the time, are things like VAR, standard deviation, variance, semi-variance, things like that. Those are not easily allocated out to the parts without doing some other, assumptions. Reinsurance allocation by risk measures. I've had multiple people tell me you shouldn't allocate capital. I list Don Mango, Gary Venter. I peeked ahead through Steve's slides. Steve says that also. My response to them has always been, but I have to do it to evaluate pricing adequacy. There's not as much of a disagreement as you think. It's semantics. We're trying to achieve the same thing. It's the semantics as whether or not you're allocating the capital, or you're kind of trying to measure the average consumption of the capital to do it. And hopefully Steve will give a better explanation of that. So there's really not an argument. It's aggressively agreeing or disagreeing about the terms. In the allocation methods that were in a paper by Gary Venter, proportional spread, that rescaling of the standard deviations to add up to the total is one example. I add them up, I get it back to the total, I rescale it, I get it back to where I need it to be. The marginal additional risk, how much additional capital is needed to support the added risk coming in. Game theory, other there was quite a few listed in Gary's papers. But one of the main points that I firmly agree, and I see violated all the time, I have violated it probably more often than not, is that your pricing, your cost allocation, your capital requirement should all be done in a consistent manner. If you're not doing it on a consistent manner, you're going to get some outliers, you're going to get some things bulging out that shouldn't be bulging at the time, and you're going to get some wrong answers. Less correct, maybe not wrong. The current state. So marginal pricing. Marginal pricing is the big name of the game now for most people. People hire teams, probably only second to your capital model. People spend more money on their capital models than they spend on their marginal pricing system, but that's a big deal. In the early 2000s, there was just a couple of people doing it. You see more doing it, but the whole simple idea behind it, I have a portfolio. I add a new risk. If I add that, and within that portfolio, I can calculate a capital consumption. I can calculate a profit from that portfolio. I add a risk. How much does that change my capital? How much does that change my profit? Am I getting enough profit to justify that additional capital? That's it. Complexities in the details and the cost and everything. But really just a matter of either you need to be doing the selecting or you're being selected against. And that's the big point of the marginal capital, is how can I price this in the best way for my portfolio, for my book of business. Issues with doing it, you can't ever get the IT ghost out of the room. The cost of doing it is an issue. Is it worthwhile to do? I can't answer that. It's your job to convince your senior management of that. Speed. As people were first doing it, sometimes it was taking a long time to update and get the price, where really the attention span is in seconds, not in minutes, and definitely not in days to get the answers. The number of simulations. A lot of people think, okay, well, I have a number of simulations. I'm using AIR, for example. Their sample set has 10,000. I must be able to do everything with that 10,000. The more you subdivide the data, the more samples you're going to need to get convergence. I did a presentation to a syndicate here quite a few years ago. I know they were using the 10,000. I showed, and it was actually right before those earthquakes I mentioned happened, so I felt a little vindicated about it. What was the allocated cost of capital to the minor regions? And I showed with 100,000, with 1 million, with 10 million. Well, going from 100,000 to 1 million changed the answer fairly a lot. Going from 1 million to 10 million, in that case, didn't. And the question from that group was, well, what if you're just doing 10,000? And my answer was, I never considered doing that few. If it's for your whole company's capital, it's not going to make that much of a difference. If it's for the group trying to price, for example, Chilean earthquake or New Zealand earthquake, if their capital being allocated them is off by a factor of 3, that's a big deal. That's a big price change. Another issue, and you have to have a consistent vendor model generally to be able to do the calculation. The portfolio you're using. Often people will use the term a reference portfolio. Now that reference portfolio can be your actual portfolio. Or it can be just a made-up portfolio, your target, your aspiration, what do I want to be when I grow up? That's actually much more significant when you're a smaller company trying to grow. If you're using your live data, or the reference, what's the frequency of update? Do you update it live after each deal? Do you do it daily? Do you do it weekly? Do you do it at the end of the renewal season? Having your reference portfolio change impacts your pricing. And that's something you have to come to terms with and explain to people. If it's a renewal, do you remove itself from the portfolio before you price the renewal to see, what it's going to do? If not, if it's your biggest risk in the portfolio and you don't take it out when you evaluate it, you're double correlating it with your portfolio, and it's going to look riskier than it really is. Pricing issues when using a live portfolio. Well, that's one thing that you have to just accept. The indicated price that you give when you price it is going to be different than when it's bound. because if you're updating the portfolio, it's a different portfolio than time. There's a time lag between quote and bound. Every time you update the portfolio, that means that the order that deals come in, it's going to affect the price. If it's a peak zone, someone else from your peak zone came in, the price is going to be proportionally higher. If it's, a non-correlated, a diversifying zone, whatever you want to call it, it might be better, it might be worse. The uncertainty of the final line size affects your portfolio and how much it impacts. Unmodeled perils, what do you do about that? The whole idea of a marginal pricing system is it's all modeled. And so you have to do something about unmodeled perils to reflect the risk. Regardless of which of those methods you do, one thing that I believe you have to do is doing a post-renewal scoring. Take out a small piece of each one of those deals and check the impact on the portfolio and say, is that a desirable risk? Used to work with one client to every risk that came in, they would do a scoring on, and then they did the whole portfolio. And quite often there'd be a reasonable number of risks that said, oh, it was a great one when we wrote it. Now that it's in our portfolio, how do we get rid of it? And that's just kind of crazy if you think about it that way. And, it shouldn't be just because of their perspective that you want to, bring something in and then get rid of it as soon as you can. This was not done. We're going to try to do something a little bit more. But what if that survey that Major and Krebs did, what if we redid it today? So that's why I'm calling it the hypothetical survey. And I'm saying, how is it going to change from what was out there in 2002? I think it would read something like, and this is just my own judgment, my opinion, all are using CAT models. Most use multiple CAT models concurrently. Before it said a quarter, 25% of respondents have proprietary in-house models. I think that's much greater, and to throw some kudos to Oasis, they enable that for a lot of people. All should have in-house view of the vendor model used. I believe that's a requirement, given the solvency regimes a lot of you are in. Majority of underwriters have a walkaway price. That has not changed. Many, before it used to say most, are still using that reluctance pricing load. Even if that's not what's formally built into your system, you see it used as desk quotes, to get your initial indication of the price. More companies, or before it was few, assess the incremental impact of new contracts. So more companies are doing the marginal pricing. We're still doing the aggregate management. The conclusion would be the state of insurance is still in transition. It always will be. So let's don't kid about that. But not as much universal progress has been made as would have been expected in 2002. I think if you thought what we were looking at and we had the roadmap in front of us in 2002, you'd think we were further along than we really are now, my opinion. So the future. So the future is the next presentation. At this point, I'm going to hand it over to Steve. I'm going to give my intuitive plug on what Steve is doing, because he's also doing John Major. I used to work closely with John Major while he was working on this as well. I believe as an industry, we have managed the CAT risk fairly well. If you look at the number of insolvencies due to CAT risk, we do it pretty well. And one of the reasons we do that is we completely focus on the tail metrics. If you look over the last 20 years and you see what companies have gone out of business because of solvency, if you exclude Florida CAT, which that could be a whole separate discussion, almost all of it has been on pricing adequacy, reserve adequacy, things like that. Things that don't show up in the typical tail metric that we're using for most of our capital evaluations. So we're doing something wrong. And so hopefully I'll turn the time over to Steve to help show us how we can do something more correctly.
So we were saying we're going to hold questions to the end, but I want to ask you one.
Okay.
For two reasons. One is, for some really weird reason, the audience would rather not see my face and they'd rather listen to you. So while I'm changing the slides, I thought I'd ask you a question. So the question is, if you look at Rodney's expected loss plus reluctance load concept, which concerns me for a few reasons. But the main reason it concerns me is some of the work we've done over the years has shown that actually the uncertainty in cat models is generally greater than most people are aware of, and it's definitely greater than any one model can express very well. So if you just accept that premise for a second, what does that do to the efficacy of Rodney's that particular pricing methodology? Does it make it better, worse, or whatever? And I'm going to do this one we didn't.
Well, I'll mention another. John Major did another paper on the uncertainty in cat modeling, and we're never going to address that completely. The biggest issue is simply there's more volatility in the cat model, in the cat experience. Forget the models, in actual cat, than we can estimate, than we can quantify. They've made great strides in 20 years, and people will notice as they have increased the detail of the modeling, the price has gone one direction. It's gone up. So my concern would be the simpler your model is, the more likely it is you're going to be pricing things wrong. One thing that I see in Rodney's model is, well, first of all, the reluctance factor. We all choose it judgmentally. If I see people using it, it's all in nice, even 5% increments. I very seldomly see a default reluctance factor load. Part of his paper actually tells you how to calculate a proper reluctance factor. But if you look at how it impacts as you move through the range, if you're using a fixed value there, you're getting the wrong answer, either on the high end or the low end. I won't tell you what. You ought to be able to figure that out. So I just think the formula is just simply too simple to account for those additional risks. But that's going to continue to be a problem.
Okay, Steve, thank you very much. Right, so one Steve down, one to go. Mr. Mildenhall, do you want to go next?
No, thank you. It's a huge pleasure to be in front of a real audience. I don't think I've talked to actual people live since 2019, so it's just fantastic to be in front of a real group of people again. So you're probably fed up with seeing this. I want to just start with a few words about why I wrote it, or John and I wrote this, and what we're trying to get out of this. And best way to explain that is to go back to one of the seminal business thinkers of the early 20th century, A.A. Milne. Probably known to many of you, he wrote Winnie the Pooh. Hopefully everyone's aware of Winnie the Pooh. And Winnie the Pooh, if you read the book, it begins with Christopher Robin dragging Winnie the Pooh down the stairs behind him, and Winnie the Pooh's head is going bang, bang, bang on the steps as he goes down. And Winnie the Pooh thinks to himself, you know, there has to be a better way of going downstairs. If only this banging would stop for long enough that I could think of it. And I always thought that was a perfect picture of the business world, right? You had all these people, and they kept asking these questions, and they wanted answers, and you never really had time to stop and think about what was the right way to answer the question. And I think both John and I felt, as we sort of started out in this project, and this was about a 5-year project to write this book, that there were some good answers probably out there. We probably weren't even going to have to create any new theory ourselves. We just would need to read what a lot of financial economists and people have worked in this area. If we could just read and digest what they said, there'd probably be some good answers to the questions that we were struggling with. And that indeed turned out to be the case. I think that, there's no important paper that we reference probably that was written after 2010. A lot of the really important papers were written in the late 1990s and early 2000s. So when we talk about modern, it's not really that modern. And it's simply a matter of getting everybody to know there was a bunch of things that were known, but they were not widely known. And really what we wanted to do as part of this book was to facilitate a better discussion between actuaries, their clients, management, capital providers, where, for example, we could all use the same terminology. So you're going to discover that Steve and I have a different meaning when we say sub-additive, right? And so what we want, one of the things we want to do here is just let's get those definitions down on a page, hopefully get this embedded into education for the next generation of actuaries, and we can just have a much more effective discussion around risk questions. So that was really part of what we were trying to do. So what am I going to go through? There's three parts to my talk. I'm going to begin with Adam Smith, who had a lot of very intelligent things to say about insurance pricing. We're going to discover that we need 2 risk measures to price with, and we're going to get to this tricky question about cost of capital. It's going to come up a lot through my talks. The middle section, I'm going to provide you a very nice theoretical answer. I think it works extremely well in theory, but as always, there's a little bit of a difference between theory and practice, and it won't quite work in practice. There's a couple of issues that we'll then try and address in the third section, where I will pitch the case for not allocating capital and allocating profit directly. And also we'll get into these discussions we've already had around, okay, well, the CAP models have got uncertainty around them. How should we address that? And what is the impact of that on the modeling and pricing work that we're going to do? So let's begin with what does theory say the answer is? Well, it's not really the answer. It's an answer. There's a lot of potential ways you could look at this. And I should say, I wanted, as I was writing this, to come up with some sort of basic, simple model that I could say this works. Okay, it's not a perfect reflection of reality, but it's a version 1.0 model, if you will. There'll be things wrong with it. We can fine tune those, but let's just get to that starting point. So you'll see a lot of the things that I'll go through here. You'll say, well, that's a little simplistic. It maybe doesn't reflect all of the risks that you actually face. That's fine. I wasn't trying to. I'm trying to walk before I could run, right? So it's going to be a simple starting point. All right. So let's begin. Adam Smith. I wanted a nice sort of punchy quote to start the book with, and Adam Smith often has a lot of really good things to say about economic topics. So I thought, well, let's look in the Wealth of Nations and see what he said. And if you do that, you look up insurance in the index, you get this remarkably forward-looking view of insurance comes out of it. So he says that in order to make insurance a trade at all, the common premium, and by common premium he kind of means average or total premium, must be sufficient to compensate for the common losses. So we've got to pay for expected losses as part of our premium. The expense of management, we need to cover the expenses. And then the real insightful part was, he says, and to afford such a profit as might have been drawn from an equal capital employed in any common trade. Okay? And this was written in 1789. So about 230 years ago, I think about 100 years after Lloyd's was founded, so not quite as old as this august room here, but over 200 years ago, he was already connecting insurance pricing to the amount of capital that you need to support the business. So he wasn't thinking of it in terms of a margin on losses or sales. He was directly tying it to capital. So very, very forward-looking way of thinking about pricing insurance. So in fact, certainly, there's a distinction, and it was brought home to me sort of listening to Steve talk. There's a little bit of, I think, two cultures here. There's a definite sort of European culture around actuarial work and pricing, and there's a US culture in that, and they're somewhat different. Certainly on the US side, everything got going with, well, we're just going to load 5% margin on everything. There was a thing actually called the Commissioner's Decision that I think came out in the late 20s that promulgated a 5% underwriting load is sufficient for every line of business, except for property, where you had a catastrophe load of an extra point, but it was catastrophe as in fires, not catastrophe as in hurricanes, because it was for conflagration risk. So this idea that Adam Smith has of tying back to capital is already kind of well ahead of where things were in the US, certainly for many decades after insurance got started in the latter part of last century. All right, so we're going to have a simple model, as I said, walk before you can run, and we've got a cast of 4 characters who come together to sort of make this market work. So we've got a bunch of insureds who've got some risk that they're trying to offload for various reasons. Often, and we often ignore this, they are offloading it because they have to, not because they want to, which is an important consideration when you think about buying insurance. So there's a lot of insurance which is a mandatory purchase. It's not really an optional purchase at all. So there are our source of demand. And so we have insurance companies formed who are going to write that risk and take that risk off our insureds. And they're going to do that with support from the capital markets, who are going to provide that capital buffer that's necessary in order that they can make, the insurance companies can write leveraged promises and pay out more than premium that they collect. And then sitting over top, we've got a regulator. Okay, and in most countries and in most lines of business, you have a regulator. And this goes back to the fact that often insurance is a mandatory purchase, and the buyer is buying it actually to protect a third party, so they don't have a direct interest in the quality of it. And for mandatory insurance rules to be effective, you need to have solvent insurance, so you need to have a regulator promulgate capital standards that the companies are going to run to. So the process here is going to be the insurance company is going to decide to write a bunch of risks. The regulator is going to look at those risks, and they're going to decide on an asset standard. They're going to say, all right, if you're going to support that body of policies, you need to have this many dollars, pounds, euros of assets available to you. Now you say, well, wait a minute. It's usually expressed as a capital standard. I'm saying it's an asset standard. So assets are the sum of premium and capital. And there's obviously an offset, or at least there should be an offset between capital and premium. If I doubled my premium for all lines, I should actually need less capital. A lot of solvency models don't work like that, but it is, it's a less risky proposition if you've collected more from the policyholder. So I'm going to think of the regulator as promulgating an asset standard. And now what needs to happen is the insurance company has only got two sources of money. It can raise money, premium by selling the insurance policies, and it can raise capital from the capital markets by selling what it essentially sells is its residual value at the end of its life when it has paid off all its claims. So the insureds pay in some premium, and the capital markets buy the residual interest off the insurance company, and that funds the insurance company up to the asset standard demanded by the regulator. Now, there's a couple of words that I've added here that you may not be so familiar with, at least in an insurance context, which is the ask and the bid. So probably you're familiar if you've done stock trading. If you go to a broker and you ask for a quote, you'll get two quotes, right? You'll get a bid and an ask, depending on whether you're interested in buying or selling. And in the insurance context, what we're thinking here is that I say the premium is written at the ask price because the insured comes to the insurance company and they ask them, what's the premium going to be on this policy? Okay, and it's a matter of who is skeptical of whom in terms of the premium. So the underwriter is skeptical of the risk, and they're thinking, well, the risk is probably going to be slightly worse than they're representing, so I need a positive margin on that, which you're going to bake into your premium. Okay, so premium is written on the ask. When you go to the capital markets, now the equation is flipped around. The insurance company is going to the capital markets and it's saying, I want to sell you this residual. So now the capital markets are the skeptical side, and they're going to say, well, I will bid a certain amount for your stock or your bonds or whatever the issue is, but they're skeptical of you. And so they will pay you less than your actuarial expected value of your residual for, that they'll pay in terms of capital. So in a sense, you can regard an insurance company as collecting a bid-ask spread from insureds. They sort of pool it and transform it, and they pay it back to investors. And it's one of the sort of transformations that's going on here. I'm thinking of this as a simple one-period model, so very relevant to the way Lloyd's operates. This is going to be a company. It comes into existence at time zero. It writes its premium. It raises its capital from investors. At time period one, everything becomes known. It pays its losses. If there's any money left over, it gives it back to the investors as a residual value, a dividend or return of capital. So this comes back in a moment. We will see. Yes. So it is also a limited liability insurance company. If losses turn out in the aggregate to be greater than the assets, it only pays the amount of assets. It only pays the money it's got, and it defaults in some way and allocates the monies between its insurance claimants. And then on the other side, if it gets to the end of the period and there's some money left over, it distributes that back to the capital markets. Okay, so this is the sort of framework and the model that we're going to be working with. So let's look at how we might translate what Adam Smith said about pricing into modern language. And I should mention, to begin with, I'm not going to be considering expenses at all. You can load expenses in. I'm purely interested in getting to that risk-loaded loss cost component. You could regard the expense component as a sort of separately marketed thing, and it had a separate price. I know it gets bundled in, but we don't need to treat that separately. The other thing is I want to look at this as Adam Smith pricing at the portfolio level. Okay, so In the book, we split, the book is sort of divided essentially into two halves. One treats the pricing of the whole portfolio. And then the second half says, okay, once I've priced the whole portfolio, how do I allocate that price down to the individual pieces? And at the moment, I'm thinking about just the total portfolio price. So the ingredients that we've got are, we've got some random variable that represents our losses, always called X, so total losses, and then we've got the amount of assets that the regulator, and it could be a regulator, it could be a rating agency, it could just be market forces that you're sort of, to be credible in the market you're writing in, you need a certain level of capitalization, but you need to show an amount of assets that's going to depend on your losses. And then you've got some cost of capital that's implicit in the bid that investors made for your residual interests, which are called IOTA. And a few observations on this. Firstly, as I've said, only two sources of money, no magic here. Assets equals premium plus capital. We've got the two risk measures. One is tail risk measure that determines the amount of assets we need. But I would also regard a pricing functional, something that you put a risk into and it tells you a risk-loaded premium. That's also a risk measure, right? It's a risk adjustment of the expected loss. So I use the term risk measure to refer to both tail measures and pricing measures of risk. The asset amount we're regarding as exogenous is given to us sort of by the regulator. You could choose to think I could write it, 5-to-1. I don't write it, but if your regulator says you can't do it, then you just can't do it. It isn't going to work. We are also pricing the losses up to the amount of assets. So again, we have this ability to default. And so we've got already a price that's related to a capital structure, which certainly in the US literature was something it took until about the 1980s for people to sort of recognize that there is a slight insolvency haircut there in the pricing, and that you need to relate your price to your capital structure. So the more capital you have, in just ever so slightly, more premium you should be able to charge because you're selling a higher quality product. Okay, so what I would sort of call the Adam Smith, COC stands for cost of capital. What is the Adam Smith cost of capital pricing formula? Well, he said the common premium covers the common loss, so it's got to cover the expected loss, and then it's got to cover the same return as equal amount of capital could obtain in any other industry. So we're going to have expected loss, and then we're going to have an amount of capital times some cost of capital rate. So this amount is going to be in dollars, pounds, euros, and the cost of capital is going to be a percentage. Okay? So you see that we've sort of got P on both sides because the amount of capital, because assets equals premium minus capital, the amount of capital is just A minus P, and so I've got P on both sides. Whip out the pencil and paper, do a bit of rearranging, and you get a number of different expressions for capital here. So the first one is, I can say capital is expected loss plus a risk margin. So assets minus expected loss, everyone would agree the policyholder should pay for the expected loss. The piece that's up for debate is the rest, right? So assets minus expected loss. We call that the unfunded liability. That needs to be split between policyholders and investors in such a way that the margin to capital equals the cost of capital. And if you do the math on that, you introduce factors like the risk discount factor and the rate of risk discount, same as from the theory of interest. Hopefully everybody remembers, V equals ID and V plus D equals 1. You remember that from an early exam, maybe a long time ago. But that D to V gives you the appropriate splitting of the unfunded liability. So this second expression is expected loss plus risk load. Or you can think of premium, because premium equals assets minus capital, assets minus this V times A minus EL. This is the amount that the investors bid for your residual, right? So this is the actuarial value of the amount of money they're going to get back. And then V is their skeptical factor that they discount it somewhat less than 1. And that's what provides them an expected return on that capital. And then you can also rearrange it into this form, which is V times expected loss plus D times assets. And this one's quite interesting because, so expected loss is just, that's an objective measure of expected loss. The V factor is going to be about sort of 0.9, somewhere in that sort of range, right? So it's about a 90-10 weighting. And then A in this context is the worst loss they can possibly pay, because the insurance company's only got assets A, so it's the worst loss they can pay. So this pricing formula is saying the premium is it's sort of like you can imagine your underwriter, and they're like, 90% of the time I'm completely risk neutral, and I'll just give you the expected value, because that's going to be my premium. But the other 10% of the time, I just think the worst possible thing's going to happen, and I'm going to charge you the maximum loss I can pay. That's the pricing rule, okay? And that's a sort of very standard way of loading for constant cost of capital that you get. And the common refrain you hear about this is, oh, my pricing formula, my allocation formulas are too tail-centric. Hopefully people have heard that, right? They force me to buy high up reinsurance is never going to pay. It just gives me capital benefit. It's because their pricing formula, if you peel back how it works, it's a weighted average of risk neutral most of the time and absolute worst the rest of the time. Okay, this is quite an important sort of simple back of the envelope calculation. So this is the method in use in a lot of US rate filings, and sort of it's assuming that in many ways we've got a constant cost of capital for various of the implications. So it's quite widely used, and this goes back to essentially what Adam Smith said about how we should price insurance. All right, so I've said a few times, constant cost of capital. Should the cost of capital be constant or not? And very influential writer, certainly on the U.S. side, is a researcher called David Cummings. I don't know if he's made it over the Atlantic or not, but he wrote a lot of papers. This is a paper he wrote about the discounted cash flow method, the internal rate of return pricing. And he said that use of company-wide cost of capital implicitly assumes that a new policy has the same risk-return characteristics as the firm as a whole. And this assumption may be questionable in a multi-line insurance company. I don't know how many people here are familiar with work that was done sort of in the late 1980s, early 1990s, but there was a move to try and apply a CAPM type pricing model with betas and systematic risk measures and so forth to insurance. Right? People tried to figure out what's the systematic risk that I've got in different lines of business. And it was not a success. I could not get reliable estimates out of it. And as a result of that, people thought, well, we could try and vary the cost of capital by line, but we can't estimate it. And so rather than introduce greater error because we'd have a poor estimation technique, let's just assume that it's constant across all the lines. Okay? And they very quickly realized, though, that that was a wonderful assumption to make. Because once you've done that, all sorts of things become much easier. If I assume all of my capital earns the same return, then to price, to add a risk load, is simply a matter of allocating the capital. Because I just hit it with my constant cost of capital, and I know exactly where I am. And this is why, in that world, you can do economic value added. You can say if this line is earning a higher return than that line, it must be better because I've got a constant cost of capital. Okay? But we need to remember that nobody ever thought that was a reasonable assumption to make. It was only made because they couldn't estimate costs of capital by line of business. So the weird thing there is that forgotten in this is there's at least two dimensions that you can think about the cost of capital varying. Yes, you could think of it as varying across your different lines of business, but you could also think of it as varying up and down your capital tower. Okay, because you're raising capital, it's not all equity. You've probably got some debt, and you've certainly got some reinsurance capital in your capital structure. And we all know if you go to any newspaper published anywhere in the world and look up bond prices, you can see that highly rated bonds that are essentially at the top of the capital tower have a lower return, a lower cost of capital than lower rated bonds, right? AAA is the cheapest, and then AA, This was a whole thing that we did with mortgage-backed securities and tranching that sort of was part of the financial crisis. So we know that, and we've always known that, and it was just sort of conveniently forgotten because we love the fact that life is so simple if we just assume a constant cost of capital. And really what the rest of the talk is about, and a lot of the techniques in the book are going back to that idea of, no, if I am more removed from loss as a capital tranche, then I'm going to accept a lower return than more exposed lower down business, which you see it in reinsurance pricing as well, right? The reinsurance prices for cat programs go down as the attachment goes up. What are the implications of that, and how could we potentially factor that into a broader way to price business? You might be a little concerned here that if I don't know, how many people have like a sort of finance background? Are you all actuaries? I guess I maybe should have started here. Who's an actuary? Show of hands. All actuaries. Okay, almost all actuaries. Anyone want to shout out if you weren't an actuary? What are you? Regulator, journalist, spy, cat modeler? Cat modelers?
Cat modelers about 20%.
Cat modelers, okay. And capital modelers, but you'd be actuaries, right? So, all right, so more broadly actuaries. Anyone do finance in college? Anyone guess what MM stands for? All right, well, I'll just skip that point then, because it was Miller-Modigliani, but it's a non-issue. Okay. All right. We've had Adam Smith, so that was all 200 plus years old. Let's sort of try and move into the modern. And again, in the book, we split it into, we've sort of got three splits. We've got a split into theory and practice. We've got a split into pricing, portfolio, and allocation. And then we've got a split classical and modern. And our dividing line between classical and modern is 1997, which is chosen as the average, it's very actuarial, it's the average publication date of three kind of watershed papers. The first was Sean Wang's paper that, I'm not sure if this is exact, it's either or a bunch of papers. This is the one, all right. So premium calculation by transforming the layer premium density, which was published in Aston in 96. On the academic side of things, it's all about citations. That's the currency. The more citations you've got, the better. This paper has 891 citations, which is I think is one of the most highly cited actuarial papers ever written. Certainly general insurance. There's probably some life, because life is a bigger area, but I think as a general insurance paper, this is one of the most highly cited actuarial papers out there. Introduced the Wang transform and the proportional hazard and explained how to do that kind of additive pricing of different layers. Very influential work. The second paper, probably less, just who's heard of Sean Wang? Okay. Probably nobody's heard of Rich Phillips then. Okay. So this is maybe more of a US thing. He wrote a paper in 98 about pricing in a multiple line insurance company using option theoretical framework. And the big thing that he brought in was this recognition that you've got to allow for default. You've got to allow for the fact that there's a pooled set of risks. They share one capital. They can all get all of the, each of them has equal rights to the capital, and you've got to allow for how the risks come together and potentially interact, and how potentially you would get default coming out. This is lives in a smaller fishing pond. 336 citations, still quite a lot, but it's a pretty abstract area, but very important in terms of thinking about actuarial pricing in a multi-line insurance company. The third paper, however, is enormous. This is, the internet leads me to believe this is Freddie Delbain. I know the other two chaps quite well. I've never actually met him. So if anyone knows him and that's not him, please tell me. But the internet assures me, Google assures me that this is Freddie Delbain. And in 1997, Artsner, Heath, Eber, and Delbain wrote a newspaper, basically a magazine article called Thinking Coherently, which they followed up with a paper called Coherent Measures of Risk, which, as you can see, has had now 11,928 citations, which actually averages out to more than one a day since it was published. I updated the draft I sent Dickie 2 weeks ago. It was at 11,914, so it's very much a relevant thing. It's still being cited. And this is by far and away the most important papers ever written about how should we think about measuring and managing risk. So we should pay some attention to what they said. So let's look into that. Their approach was to, rather than start with this sort of zoo of, I think we should use, reluctance factors and a bit of standard deviation or a bit of value at risk or whatever. They said, no, let's just step back and let's say, if I've got a pricing functional or I've got a risk measurement functional, what properties do I want it to have? What would be desirable characteristics? And there's 4 here that I list. The first one is called monotone, which is I think unimpeachable, which is if I've got 2 risks, and one of them in every state of the world pays more losses than the other one, then the premium for the first one has to be higher than the premium for the second one, right? Hopefully there's nobody who would argue with that, right? So I've got two policies. One is always going to pay more than the second one. It should have a higher premium. The second is, and this actually highlights why we need a book to normalize our language, because I see you were not using subadditive in the same way that I was using subadditive in the book, is what the coherent guys call subadditive. And the idea here is, why does insurance work? Insurance works because if you pull risks together, they become somewhat more predictable, and you can economize on your capital. So we would like a pricing or a risk management functional to have the property that diversification, that pooling decreases risk, in the sense that the risk of a pool should be less than or equal to the sum of the risks of the parts. And one of the ways they phrase that is that for a risk management perspective, I want that, because I want to be able to manage risk by unit and know that if I manage to a certain threshold by unit and I add up the capitals I need, I then have enough to manage the risk for everything when I've pulled it together. So it's a very important characteristic for risk management. And it's, I think, a reasonable characteristic for pricing, because we're thinking, why do we have a risk margin? We have a risk margin because we need expensive capital to support the risk. So if we believe that pooling risk makes it less risky, then the price of a pool should be less than or equal to the sum of the prices of the parts. Okay, so that's a pretty solid idea. We like subadditive. The third one, which is actually what Steve called subadditive, I'm going to call something different, is called comonotonic additive. So the idea here is, all right, subadditive because the pool is less risky than the sum of the parts. What if the pool is not risky, not less risky than the sum of the parts, right? So what if I've got a pool, I've got two risks together, and when I combine them, they are no less risky than they were independently, okay? In that case, I don't want to give any diversification benefit. Okay, so that's what's called comonotonic additive. If you've got two things that don't diversify against one another, you want their price of the sum to be the sum of the prices. Now, the trick there was, it took a long time for folks to understand, what does it mean they don't diversify against one another? Because you could argue, well, does that mean they're perfectly correlated, perfectly linearly correlated, for example? Well, that's no good, because that's just measuring one particular type of association. And after a fairly long struggle, it came out that the correct notion of they don't diversify is if you've got two risks, and if you sort them from lowest to highest, they match up. So they both have their best outcome on the same event, and they have their second best outcome on the same event, all the way up to they have their worst outcome on the same event. And if you've got two risks like that, they're called comonotonic. There's no diversification effect whatsoever, and we want their prices in that case to add up. And if you've got two layers of a given risk, they have that exact property, right? There might be some ties, but they basically move in lockstep in that way together. So there's those three unimpeachable. The fourth one is called law invariant, and this is, I want the price only depend on the distribution of outcomes. Now this one you could argue with all day long, and you would probably be right to, but this I will justify on two bases. Firstly, I want to walk before I can run. I want a simple model. And this is, actuaries have traditionally called these things classical premium calculation principles. And I wanted just to work in this simpler world to get started. The second reason to do this is, by and large, the risks that we write are uncorrelated with one another in the finance sense of, we don't have that sort of notion of a stock market that's moving up and down. Right, all your auto policies, yes, they've all got inflation that sort of hits them together, and maybe a bit of weather and what have you. But there's a much greater degree of independence between them than there is on the stock market, and so there is less need to be thinking about systematic factors. But that one we can absolutely argue with. But for the rest of this talk, I'm going to assume that price only depends on the distribution, and so in particular, it's not going to be legitimate to say this line gets a higher risk load simply because it's labeled with this line. It has to earn the higher risk load through having a more volatile set of outcome distributions. All right. So this is not exactly the list that the coherent risk measures paper came up with. If you combine the first three, you get, there's two other things that come out. One is called proportional homogeneity, which means the risk scales nicely. And the other one's called translation invariance, which means if you add a constant to a risk, then you should just change the risk by the constant. So it doesn't, adding a constant doesn't alter the risk profile in any way. That defines what's called a coherent risk measure. And what the importance of the coherent risk measure paper was, they explained precisely what all the coherent risk measures were. They gave us this description of how you could build them and work with them that's proved to be very useful and fruitful. Now, these four together define what is called a spectral risk measure. So a spectral risk measure is any risk measure that has these four properties. It's a bit of a mouthful, but it's a law invariant comonotonic additive coherent risk measure, right? That's an example. And you should be thinking TVAR. TVAR is your classic example of something on the left-hand side, right? The Artsnet paper, the Delbane paper with the 11,000 citations essentially proved, all right, if I've got a spectral risk measure with these guys, how do I make it? I've got four characterizations of it that are very concrete, very tangible, very easy to work with. The first one is, it is a continuous increasing weighted average of values at risk. So I can take some function that increases, and if I weight, and it integrates to 1, and I weight down value at risks at each of those different thresholds, giving a higher weight to a higher value at risk threshold, so I'm getting sort of more and more risk averse as I go on, then that will give you a spectral risk measure. The second representation is it any weighted average of TVARs, okay? Because TVAR already accounts for, it goes from a point all the way to the tail, it sort of does a lot of the work that you need to make things fall out correctly. You can just take any arbitrary weighted average of TVARs. So you can pick 3 TVARs and weight them a third, a third, a third, or 2 and a half, or just 1 TVAR on its own, or a continuous weighted average of TVARs. They will all be spectral risk measures. Okay, so that's a very concrete, easy way of thinking about it. The third method is you can think of them as the worst risk-adjusted outcome, where you've got some set of risk adjustment functions z. So if you think of what this expectation is, right, it's an integral of x, z, little f of x dx, right, is an expectation. So if you've got a z that is positive and integrates to 1, z times f defines a new risk adjustment. You're making some outcomes more likely, some outcomes less likely. Generally, the way you'll do it is you'll make the bad outcomes more likely, good outcomes less likely, and you'll increase the mean, and that way you build in a risk load. So the third way to get spectral risk measure is you just pick some collection of risk adjustments, different scenarios, if you will, on your probabilities, and you just take the worst one of those for any risk that you've got. That will define a spectral risk measure. And then the last method is what's called a distorted expected value. So this is, this goes back to Steve's equation he had for the Wang transform, which was the integral of s to the 1 over rho. So the 1 over rho function is an increasing concave function that thickens up the tail. I can use any g with those properties. So this g function is increasing. It's going to make the tail of my distribution bigger. It's going to increase the mean. And this expression is going to define a spectral risk measure for me. Now what I can do with this is you can do an integration by parts trick, and you can write this as the expected value of x times g prime s of x, which not coincidentally looks exactly like this, right? This is now my risk adjustment. And this opens up the way to do an allocation that's very nice. We call it the natural allocation in the book. Freddie Delbane actually coined that phrase in one of his papers. He said that doing an allocation like this is a very natural thing to do, and it is. There's no extra assumptions that need to have gone in here. I've got my G, I get an allocation for free. It pretty much always works. And all you're going to do is, if you've got X as a sum of little xi's, then the allocation is just xi times the risk adjustment, okay? And that's going to be what we'll be taking as the price for unit I. All right, so what are these distortion function things that are a little abstract? Basically what they do is they price 0-1 bets with a different probability of having a loss. So you take S as the probability you're going to have a loss, and G of S is going to be then, all right, if I ask you to insure that, how much premium would you want? Okay, So on the left-hand side, this is the probability of loss ranging from 0 up to 1. The dotted line is going to give me the loss cost, right? Because if I've got a probability S of a loss of 1, then so like at 0.2 here, my loss cost would be 0.2. And then the G of 0.2, it would then be, that's the premium I want for this, okay? And you can see you've got all your sort of standard insurance friends here. You've got your loss cost. To write that risk, you would need capital of 1, right? To write a risk that paid 1 in the event that a loss had. So I'm sorry, you need assets of 1. So you need capital of 1 minus G of S. G of S is the premium. So premium plus capital adds up to 1. And then this distance here is the margin that you've got on the deal. And you're getting relative to the loss cost, you're getting relatively more margin for the top layers of bonds than you are for the bottom, right? Down here, there's hardly any margin at all, okay? But up here, the margin is quite large compared to the loss cost, okay? So you're thinking now, the game, and this I think goes back to Gary Venter did this in the 1980s, said, all right, if I've got an overall risk, right? So if I've got a risk here, these are my outcomes, which I've sorted it by size of outcome. The dotted line is my loss cost outcome. I can think of selling the one particular layer of loss out of this, right? So I pick a layer X, then the chances that I have to pay, if I've got $1, it's like I've written the layer $1 excess of X. The chances that I have to pay that is the chances that my loss is greater than X, which is some amount here. This is S is going to be 1 minus P. So this is going to be my loss cost. And then this picture sort of annoyingly is a rotation of the picture that we had on the previous slide here, right? So here we've got loss, margin, capital. Here we've got for this layer, loss, margin, capital, okay? And if you add them all up, you know, the regulator says you need capital A. If you add everything up, you've got your loss cost at the bottom is the area under the dotted line here. So that's just your expected value as the integral of the survival function. You've got your margin as the area under the premium function here, sort of the difference between that and the loss. And then this block here is capital. And we're used to sort of laying this out on an expected basis like this. What we're doing here is we're sort of thinking of it as, I haven't just sold it all at once. I've sold it in tranches. I've sold it sort of $1 at a time. And each investor has bought $1 at a different place. And they've all paid slightly different amounts for their dollars. And obviously what's going on here is, you know, if the loss is, say, X, then all of these investors down here that bought X or lower, the low layer players, they all lost their investment because it all went to pay losses. And everybody above here, they get their full amount, the dollar back. So they contributed sort of this much up to the capital, and they get a full dollar back for that because their layer didn't have a loss, okay? Now, what you see with this is sort of a very important point that if you're at the top of a capital program, you've got a very small loss component here. You've got a pretty large margin component. So what that means from a premium perspective, your risk-loaded premium is way more than your expected loss. So your loss ratio is very low, right? But up on the capital side, you've got this much capital, you've got a lot of capital, and relatively little margin. So the ROE is actually, or the return on capital, is actually quite low, okay? So top of the program, low loss ratio, low return on equity. Bottom of the program, now you've got big old loss cost here, hardly any margin on it, so much higher priced loss ratio. But look at the capital situation. You've got, yeah, there's not much margin in there, but there's not much capital in there either. So this is like up here is like a AAA bond, right? Very low cost of capital. Down here is equity. And you've got 15, 20, 25. You tell me what what's your average return on equity target? Probably everyone says 15, but that's blended over the whole thing. This is sort of low equity. Equity isn't tranched in reality, but this picture would be about a 50% return, right? If you were to sell that on its own, because it's got a, 90% chance of having a loss. Okay? So it's a sort of extraordinarily risky to the capital provider there. So it's important to sort of bear in mind what we think of as risky on the insurance side is typically going to correspond to a low loss ratio, but it could also correspond to a low return on capital because It's going to be very unlevered. And as you come down the program, you get higher loss ratios, higher return on capital, but you also get higher leverage. You can see the leverage, right, is the ratio of the premium to the capital there is very, very high at the bottom there. Okay, so it's a very important sort of way of getting your head around maybe some different ways of thinking about some of these variables. All right. So that's interesting. This is an Apple effect here, because this was not in the original presentation. I don't know what that is. It corresponds arrow. All right, so that's how we're thinking about pricing in total, right? We've got some distortion function, or we've got our total portfolio risk. We've applied it to it. We've got the total premium. Now we need to allocate it, right? This is where the rubber hits the road. There are two ways to think about allocation, two predominant ways. The first is marginal. We love marginal allocations. It's so simple. This is what you do when you price against a reference portfolio, right? You add one thing to it. How much does it change? I want to go with that. Okay, so it's consistent with microeconomics. What's the profit maximization point for a firm, right? Marginal revenue equals marginal cost. It's called the Euler or the gradient allocation in various cases. It's cost-based. It is the insurer's perspective. It makes cost, if you assume constant cost of capital, once you've got the allocation of capital, you've got the allocation of cost, and you just multiply it together. And this, Venter-Mango, Krebs talked about this using the directional derivative, which was an early version of the Euler gradient approach. So this is meat and potatoes. We love this one. But then we've also got this natural allocation, which may, if you haven't worked with it, may seem a little odd, but this is mainstream finance. Black-Scholes works like this, right? The Black-Scholes option pricing formula risk adjusts probabilities, bad outcomes more likely, good outcomes less likely. It's clearly additive because you've just doing expected values. It is based on the insured's perspective, this one. You need to know actually how much you're going to pay to each insured's. And in the Venter-Mango Major Krebs speak, they talk about this is where co-measures come from. So if you've used co-measures, you've used something that's analogous to the natural allocation. Now, when John and I were working on this, I was always thinking this column, and he was always thinking this column. And we were doing our separate calculations and doing things. And we had hairy integrals that you'll see in the book. And I always assumed, well, it didn't seem to me like either of us had really made any assumptions, so these two must be the same. But that's obviously can't be the case. Well, that's an unfortunate point to lose the slide. That can't be the case because the assumptions are different. On this side, this is looking at total cost only. To work this side out, you need to know how you are allocating the payments in default. So it cannot be that these two are always the same. And sure enough, when we compared our big formulas, they were mostly the same, but there was the bit that happened in default that was different. And I was quite taken aback by that. And it was quite disappointing because we got these two great methods. Wouldn't it be a wonderful thing if they were the same? Well, it turns out, again, going back to my friend who I've never met, Mr. Delbane, he has a wonderful theorem that he proved in the year 2000, which says, under certain circumstances, they are the same. And this is truly a wonderful thing, right? Because you love marginal allocations. It's a great way to go. It's very intuitive. And natural allocation also has a lot going for it. For them to be the same, that's just perfect. So he said that they are the same, provided there's only one of these like risk adjustments, these Z's, so that the total premium is the risk-adjusted premium at that risk adjustment level, okay? Now remember, we always have the G prime S of X. The way we've set it up, that is a risk adjustment, and you've always got that in your pocket. So what he's actually saying with this is, are there any others? Are there any other ways I could come up with that correct total price that I want? And the answer is no, if and only if, essentially, I have no ties in my outcome distribution. And probably if you've worked on this and you've played games with marginal allocations and things, you know how awkward having ties is, because what do you do within the ties? And that's really what it all kind of boils down to. So I can illustrate this with TVAR. So if you all remember, TVAR is, with all due respect, not quite what you wrote down as a definition. It is the average, so P-TVAR is the average of the worst 1 minus P proportion of outcomes, okay? So if you've got an outcome distribution that looks like this as a function from 0 to 1, you're taking the worst, the right-hand piece here. Now, what I've chosen with this example is I've got a flat spot here that goes from just below my P to just above my P. So I've got the problem of what is the worst 1 minus P proportion of outcomes? Well, it's quite clear it includes all of these guys, but it only includes some proportion. It includes basically this proportion of this distance to this total distance of the ties. And now I've got complete flexibility about how I choose those. And that doesn't matter in total, but it does matter when you come to the allocation. Because although this is a constant, it could be one line going up and one line going down. And so depending on whether you weight the left-hand side or the right-hand side, or you do some crazy weighting like this, you're going to get different answers for your allocation. Okay, and that's going to stop your natural allocation equaling your marginal allocation. So what can you do about that? There's a couple of things you can do about that. One is you can do what's called the linear allocation. And that says, all right, I don't know what to do in this place where there's ties. I know how much probability I want here, so I'm just going to assign, I'm going to treat them all equally. And that, in your spreadsheet, what that would amount to is you've got a number of scenarios with the same total. You do all the permutations of them and just average them out. And that's a reasonable thing to do, right? That's called the linear natural allocation. The other thing you could do is often your distribution here, you get the flat spot because you've got some sort of reinsurance structure. You maybe got some ag stop, and this is where it attaches and this is where it detaches. So you could actually think about, underlying this, there's a distribution that increases, and you could use that to drive the order. And in the book, we call that the lifted natural allocation. And that, you know, if this diagram was sort of done, obviously, would let me take the right-hand end. So we can address those. We can address those two issues. So we've got a beautiful theory. We've got marginal equals natural kind of most of the time. And when it doesn't, we've got an explanation. Basically, when marginal doesn't equal natural, you're trying to differentiate something that's not differentiable. So it doesn't work because it matters whether you come in from the left or the right. And what you perceive that is when you do the work is the ordering problem, right? Do I grow this line or do I shrink it? I get different things. Well, it corresponds to taking a derivative, approaching the cusp from different directions. Okay, so it's a very satisfying answer. Just keeping an eye on the time here, I'm going to carry on. All right, so practice. Let's move on. How do we do this in practice? We want to do some allocations. We've got the two problems that we've got to solve. We've got this non-uniqueness problem if we've got any flat spots. And if you've got limited liability, you've always got flat spots. So you've got the flat spot when you default, right? That gives you a whole bunch of losses where you get the same outcomes. We can deal with that. Linear or lifted, it's not a major problem. But this is, when I said the theory doesn't quite work in practice, this is the problem. The bigger issue we've got is, all right, Steve, very nice theory. What do I take for G? What function should I use for my distortion? And there's a couple of ways we could approach that. We could try and get to it directly or indirectly. And direct would be, let's look for comparables, right? How do you price things in the insurance or in the asset world? You look for comparables and you take the prices off those. And remember, our interpretation of G of S is it's the price for a 0-1 risk with a probability S of attaching. Sounds like a cat bond, right? Cat bonds, by and large, you know, they have relatively thin tranches. They tend to be more or less binary. They're written at different probabilities of attaching. And we've got a nice long time series of history. We can look at cat bond pricing. If you lay it out on the chart, you get something that looks like this. This is all US wind bonds up to 2020. I got this from Morton Lane at Lane Financial. Very grateful for that. You can see the pricing all lies above the diagonal because everything's got a positive margin in relative to the modeled losses at least. This picture here just zooms in on the left-hand corner. You can see the data points only lie up to about a probability of 25% or less, and generally much less than that, as people in this room know, sort of 2 to sort of 10% kind of range probability of losses. This picture is slightly different. This uses a kind of log scale, so it blows up the left-hand corner because that's obviously where all the action is on the pricing, and you can see a sort of minimum rate on line effect going on here for even bonds with very, very low probabilities of loss. They still have a positive margin there. So this works pretty well, right? We could also look at corporate bonds as another default. They tend to have much lower probability of default than this. If you've got an A-rated, S&P A-rated company, its probability of default in 1 year is going to be some fraction of a %, so it's going to give you stuff kind of to the left of this. But the problem we've got here is that there's no data for S probability of loss greater than 20%. So once we get into the equity tranche, there's no information coming out of this as to what the returns and the prices should be. So let's turn it around, go the other way. What can we infer about G indirectly? Okay, so the way I'm thinking about this is we're going to be doing a corporate planning exercise. So we're it's in August, right? It's not the end of December and we're trying to price treaties. We're in August and we're doing the strategic planning. And your planning model says, right, to support the sort of valuation we want, we need to collect such and such amount of total premium from our insurance operations, from our underwriting operations. And so that gives us some target premium. What we could do then is we could say, all right, if we believe that this is a reasonable model, this spectral risk measure approach is a reasonable model, we could try and quantify all of the spectral risk measures that price my total portfolio to that required premium, okay? And that turns out actually to be quite a practical thing. And what we're doing with that is we're allowing for the fact that our investors have different risk appetites maybe and different risk tolerances that are going to be expressed through their different distortion functions, and we're sort of saying what are the bounds that we can put around those risk appetites. Now the way we do that is, if you think back to the Delbane coherent risk measure result that I put up, it said we had 4 characterizations of these spectral risk measures, and one of them was that there was a weighted average of TVARs, weighted average of tail values at risk. So what does that mean? It means I've picked a number of probability levels and I'm picking weights to assign to each of those probability levels. The weights all have to be non-negative and they have to add up to 1. So if you want a picture of like what are all of the spectral risk measures, you can kind of think of it as a multi-dimensional sort of simplex thing like this, where each corner corresponds to a particular p-value, and then you've got the points inside correspond to weights, right? So I might have TVAR 1, which is the maximum loss at the top here. TVAR 0 is the expected loss. Points along this line are weighting the maximum and expected. Sounds familiar, right? That goes back to our Adam Smith pricing formula. That was actually a point along this line. But then we could take any other point within this thing. And I've only drawn 4 points here because, we live in a 3-dimensional world. It's hard to visualize things more than that, but it's really a much more infinite dimensional thing. And then the condition that our risk measure prices a risk to a certain premium corresponds to putting a slice through this, a sort of hyperplane that's going to intersect this in some way. And what's going to happen is there's going to be some TVAR P threshold so that TVAR at that threshold equals your premium. It's generally in the sort of 55 to 65% range, right? So that corresponds to saying, I'm just going to ignore the worst or the best 60%, and my price is going to be the average of the worst 40% of outcomes. That's a perfectly reasonable pricing rule that you could take. And then for the edges, there's sort of 2 things that can happen, or 3 things that can happen. Both edges could be above the premium, in which case you can't average 2 things there. You can't average 2 numbers that are above P and get P, and you can't average 2 numbers that are below P and get P, but you can average a number that's above P and below P, and you can find a weighted average of those 2 TVARs that exactly results in the sort of the bi TVAR, if you will, 2 TVAR weighted average gives me the premium I want. And then all of the linear combinations of those guys will be all spectral risk measures that price to the total that I'm looking for. Okay, so I've got a handle around them. So the picture we would get would look something like this. The gray shaded area is a sort of multi-dimensional version of this triangle when I get more and more P's involved. All right, and then a point inside here corresponds to a weighted average of TVARs that prices my total risk to the premium that I'm looking for. All right? And the corner points are these points where it intersects the edges, and everything else is a convex combination of those. Okay. Now, what you get in there is a sort of interesting alignment of those. So I've drawn the constant cost of capital one. Remember, that's the weighted average of the worst outcome than the expected outcome. So this was our underwriter who was, yeah, 90% of the time I'll just give you expected, but the 10% of the time I'll give you the very worst outcome. That one's at the top there. And then the sort of opposite of that person, if in a way, is the person that says, yeah, all right, I'm just going to discount the best 50 or 55% of outcomes, and I'm going to average the worst. Right, so that person is considering not just the tail events, but they're considering more what we'd regard as volatility events as well in their pricing. So I call the top guys, they're kind of tail-centric, fixated with tail risk, and then the bottom ones, the TVAR, are more body-centric or volatility. And I know, management often, you hear they talk in terms of they're worried about the volatility risk as much as they are the tail risk. And it's a concern they have about pricing metrics that they don't reflect that volatility risk. Well, what we're saying is actually there are some of these distortion measures that do reflect that volatility risk. And then I've labeled, this is a sort of notional line in between these two that you can sort of regard as somewhat extreme. So the proportional hazard, which is the one Steve brought up, the S to the 1 over rho. The Wang transform, which uses a normal distribution to just fatten up the tail a little bit. And then the dual transform, which you can sort of regard as if you take the proportional hazard, which is quite tail heavy, and you just sort of flip it like this, you get the dual transform. That's much closer and much more concerned about body risk than the proportional hazard. So this is 5 nice distortions that give a pretty good coverage of how your investors' risk tolerance might translate into pricing. Okay, so you don't know where your investors live, but they're probably going to be reasonably close to sort of 1 or 2 or an average of these 5 distortions. All right, so now I want to put this into practice. In the book, we cover we have 3 case studies that we go through in a lot of detail. So all of the pricing methods that Steve brought up, from Venter's 2004 paper, for example, we apply all of those to our case studies, and then a whole lot of other things. We look at them standalone and in parts and whatnot. And the case studies, there's one with 2 tame lines of insurance, so that's sort of the best possible case. There's this one, which is a cat line combined with a non-cat line, and then there's one which is sort of more two thick-tail distribution. So you really get the sort of idea of the range of how the different methods could work. They all have a fairly standard and simple stochastic model. I'm not trying to do anything tricky there. So the stochastic model underlying this is the non-cat line of business is modeled as a gamma distribution. It's got a mean of 80 and a coefficient of variation of CV of 15%. The cat line is log normal with a mean of 20 and a CV of 1, which is, not that extreme, but it's certainly more kind of sporty than the non-cat line. Thicker-tailed, it's about 20% of the total, obviously. I'm going to assume the 2 lines are independent. That's not necessary for any of the math to work out, but it does make it computationally easier. So if you combine those 2, you get a portfolio, obviously, with a mean of 100, and the CV works out to be about 23.3%, which is sort of reasonable estimate, maybe slightly more volatile than you'd like for, let's say, $100 million portfolio of sort of US E&S middle market business with a sort of cat-exposed property book. We're going to assume our regulator insists on a 99.9% VAR asset requirement. And if you crunch the numbers on that, that works out to be 267.2 million units. It doesn't matter what the units are, 267.2. And I want to calibrate pricing. I need some sort of benchmark to use for the pricing. So I'm going to calibrate pricing by assuming that I make a 10% average return if I have this much assets. And that works out to be 115.15. And I'll share at the end, I've got links. All the math of this is done in Python using a library that I wrote. All the examples in the book use the same thing. I'm going to be releasing that fairly soon. It's on GitHub at the moment if you're interested, and I'll give you the links at the end. The picture here just shows the sort of bivariate distribution. So you can see the non-cat line on the X. It's very much centered around 80. The cat line on the Y-axis, much more volatile. Okay? All right. So we'll go back to thinking about our, we're thinking we're in a world, we're doing planning. We believe our investors want a 10% return to support our valuation. That means we've got to have a premium of 115.15. I want to know, I don't know what my investors' risk appetite is, but I believe they sort of think spectrally. So I want to know what are all the possible spectral risk measures they could use that will price me to 115.15, okay? And we call that the distortion envelope. So this shaded region here shows you any convex increasing curve that goes from 0, 0 to 1, 1 that lies in here. Any curve with those properties that prices to 115.15 has to live in the shaded area. So if any curve, maybe said a better way, any curve that doesn't lie in the shaded area cannot price you to 115.15, right? So everything lives in the shaded area. We've got a few here that we can look at. So the constant cost of capital one jumps up to 0.1 over 1.1 there, and then just goes straight up. So it sort of defines the lower envelope, if you will. And remember, large losses correspond to the left-hand side here. So the fact that it's the highest here means it's the most expensive for tail risk. That's why I say that, okay? The top piece here is defined by the TVAR measure. Again, it's about 0.665 TVAR. This is the most expensive for the body. So risks out here are sort of your attritional, these are your every other year losses or your every year losses. And you can see it's very expensive for those from an ROE perspective and from an insurance perspective, because the distance between the loss cost line and the premium is the greatest, right? It just maxes it out. I want 100% for those layers, okay? So that's the body-centric most expensive. CCOC is the tail. This one shows our other three that I had. So the PH is this blue one. It comes in the steepest at 0. That's why it's the most expensive on tail. The Wang is the orange is in the middle. The Jewel is the green, is the more expensive out here for the body, and it's the comes in with the smallest slope here for the tail. And that explains the ordering that I gave you. Okay, so we can use these, for example, to answer questions about how much would I be willing to spend, or how much do I believe my investors would want me to spend on reinsurance, okay? So we can compute maximum and minimum allocation pricing to subparts of our portfolio and interpret it as things like walkaway prices for potential reinsurance structures. So for example, on our cat line here, let's say we've got a quote for 80x of 41. And I picked 80x of 41 because it's got a 10% probability of attaching on just the cat line. So the 20 units of log normal with a CV of 1. If you go from 80 to 121, that takes you from the 90th percentile to the 99.5, right? So it's a pretty good sort of tail cover as an ag stop. And we can think about allocating we can think about, we've got our gross premium, we've got all these distortions that price to the gross premium. We can say, all right, what do they all price the net as, okay? Because if I buy the reinsurance, I'm left with the net. I'm going to have to go to my investors and raise the net. I think I know what their set of potential risk appetites look like. What are they therefore going to quote me on that net book of business, okay? And what we discover is that the net acceptable premium to investors will range between 105.90 for the constant cost of capital and 110.88 for TVAR, okay? So this one is giving you the most credit. If we turn it into credit, right, subtract it the other way around, we're saying the TVAR risk measure gives you a credit of 427 budget. That's the most you would want to spend on this reinsurance to then have enough money left over to keep your investors happy. The constant cost of capital gives you $9.25 of credit. And that makes sense, right, that it's in that order, because the CCOC is more sensitive to tail measure. It's going to see greater value in the reinsurance than the the TVAR metric, okay? So you turn that around, we can also compute the expected losses to this program, which work out to be 222. So if we figure what are the implied ceded loss ratios, the constant cost of capital would say, provided your pricing, your estimate of your ceded loss ratio is 24% or more, you should buy it, because you're going to make your investors better off. You're either going to add value for them, or there'll be a bit of money left over after you've paid your investors what they want. So you're creating value in that way. And for TVAR, though, because it sees less value in the reinsurance, it would require a program with a ceded loss ratio of 52% or more. Okay. Now I don't have to tell everyone here works in pricing. That is very much the relevant range for catastrophe reinsurance programs. So the little graphic there shows the price loss ratios by year on US wind cat bonds, and you can see this blue line here is 24%. It's probably, I don't know where it is. You tell me where it's gone. This year it's gone way down. But it's saying that this uncertainty around your investors' risk appetite actually has a material impact on whether you would choose to buy reinsurance at market relevant pricing, right? So this isn't just theory. This is very much saying is going to have something tangible to say about business decisions. And I think you see some of the dislocation that you see in the market today with companies taking different views on cat, partly as a result of risk appetite, sort of reflects this type of uncertainty that we've got here. All right, so we're into the home stretch now. Known unknowns. This has already been brought up with Dickie's question to Steve about, well, but we don't really know what the losses are. So I have a story to tell about that. So we've got a physicist, an engineer, and an economist stuck on a desert island here, and they're pretty hungry. And they've got this giant tin of baked beans, but they can't figure out how to open it. And they're having a chat about this, and they say, well, look, we're three smart people. We should apply our scientific knowledge to this problem, figure out how to open the tin of beans. So they go away and they think about it, and they come back together. So let's pool our best ideas. So the physicist goes first, and the physicist says, well, look, I got these really thick glasses here. I think what we should do is use the glasses lenses, focus the rays of the sun on the top of the tin, burn the tin off, we get to the beans. And the other two, they don't like that very much. So the engineer says, no. We've also got these coconut trees in the background. I think what we should do is find the hardest of the hard coconut shells, and we should just use it and just bash the top of the tin off, get into the beans that way. And the economist looks at them both and says, no. You're both missing the point here. The question is, suppose we had a tin opener. How do we allocate the beans? And I do confess to sometimes, through the whole time of writing this book, both John and I were very aware that the hard part is getting to the beans. It's getting to that distribution of ultimate losses that correctly reflects all the things that can occur. And really, a lot of the modeling we're doing is sort of window dressing around the side. And were it not for catastrophe risk, it would be largely useless, and you could just go back to it's 5%, and that's all and that probably wouldn't be too terrible. Cat risk, I think, makes it worthwhile. But we're very aware of the fact that we don't have a tin opener, and there's some very real problems. Climate change, we've got inflation, we've got reserves. Can anyone? I don't know how. I won't embarrass everyone by asking them. I think there's a whole generation of actuaries now who haven't seen inflation, and they haven't seen positive interest rates, right? I mean, interest rates have been essentially zero since 2008. This is a whole different world. So, I mean, that's a lot of learning for all of us. But climate change is one I want to focus on and just ask, all right, what are the impacts of the fact that I don't have a tin opener and I can't get to my beans of multivariate distribution? What impact would that have on the types of methods that we're talking about here? So this is a paper, page out of a paper by Stephen Jewson. I hoped he was going to be here, but unfortunately he's unable to make it. But he's done some work to try and quantify the impact of climate change on mostly hurricane frequency. I'm going to sort of blur the lines a bit and interpret this as an impact on frequency and severity, but he was actually just looking at it as an impact on frequency. And he's looking at a 2 degree C increase in global surface temperatures. And he splits it into two pieces. So he says, by Saffir-Simpson category from 1 to 5, we've got an issue that there could be potentially more or less, but it's more events, okay? And he quantifies what that is. It's de minimis impact on category 1. So you read these numbers as, for example, here, category 4, 1.179 means there'll be a 17.9% increase in the frequency of category 4 events. Okay, so we've got a shifting of the distribution because we believe there's an increase in mean. So that's one effect that can occur. The second effect that can occur is he also quantifies what is my uncertainty around that increase in the mean. And he does that by saying he fits a log normal distribution to that, and he estimates the standard deviation of those log normals across the different categories. And so, for example, for our category 4s here, he says, I believe the frequency is going to increase by the 17.9%, but distributed as a log normal with a standard deviation of 51.7%. Okay? So that's the second effect. So we've got a shifting effect, and then we've got a sort of spreading out of our distribution with thicker tails. And notice the way, if you break it into two like that, you've got one's a mean effect, and then one's a sort of no mean variance or tail thickness adjustment. And what I want to look at is the impact of, let's take the catastrophe line. So we modeled that as a log normal with a CV of 1. I want to model it now as a log normal. I want to take my original distribution. I want to multiply it by 1.15 to shift it to the right. So I'm increasing all my losses by 15%. And then I want to throw in an uncertainty factor, which I want to model as a log normal with a mean of 1 and a CV of 44%. I've got to divide out the 1.15 to get something approximates the 50% here. And I should also have mentioned that in Jewson's paper, he argues that these uncertainties across the different thresholds are all perfectly correlated. In fact, they're co-monotonic. So they're not separate draws for each category. If I see more 1s or 2s, I'm therefore likely to see more 3s, 4s, and 5s as well. They're all going to kind of move in lockstep. So it's okay to think about this modeling in this way, where I'm going to have one uncertainty factor that's going to impact my log normal distribution for cat losses. So let's run that through, and I'm going to show here, this column is going to be the base. So these were the numbers that we already discussed. We've got our gross assets, 262.7. The reinsurance limit, I said 80x of 41. It's actually 79.6 unrounded, and various other statistics we'll get to. The next two sets of columns, these middle two that say mean, these are just the effect of increasing the mean, okay? And then the last two where it says vol, additionally add on the impact of the uncertainty, okay? So it's a sort of two-step process to get us from our base model to our adjusted model going through the mean adjusted model. And so let's look first of all at the losses. Well, we had a line that had an expected loss of 20. We increased the losses by 15%, so that's 3. On 100, that should be a 3% increase, and that is indeed what we see. And there's no subsequent impact on volatility on the mean because it's just a mean effect. In terms of the split between net and ceded, originally the split was 2.2 ceded, 97.7 net. I should mention here the gross is slightly less than 100 because you only have capital up to the 99.9% level, so there is some very small chance of default. If I increase the mean, then I see a 15% increase in the losses that would be ceded to my program. So this makes sense, right? Because it was a 15% increase in the losses to the program. If I overlay then the volatility, thicken up the tails, now we have the usual effect you see with more leverage in an excess program, and you see an increase in the ceded loss of 41%. So potentially a side effect of this is going to be substantially more demand for reinsurance with a 41% increase in the expected loss being ceded into the program. The middle block looks at assets. So the way the reinsurance limit was chosen relative to the capital threshold means that pretty closely your total assets of the 99.9 are equal to your reinsurance limit on just the cat plus your net assets of the 99.9. You can see that sort of adds up. Again, 15% increase on the reinsurance, so a somewhat smaller increase on the net. But when we layer in the volatility, we're going to see overall at the 99.9 level a 30% increase in capital. So the industry as a whole is going to require more assets in order to run its business. But that's leverage between a 45% increase for reinsurers and a 24% increase net for the ceding company. Okay, so again, probably no surprise there. If we increase the losses and we make them more volatile, we're going to need more capital to support the industry. And then the third block looks at premium. So we started with our 115.15. That was our 10% return pricing threshold. And what I'm going to do is I'm going to use one distortion. So I'm going to use the dual distortion, which is not quite the TVAR one. It's not quite the most volatility centric, but it's sort of towards that end of the spectrum. It also has a property that it's kind of the average of all of those distributions that went around the outside on the hexagon. I'm not sure if that's a general property or just in cases that I've looked at, but it has turned out to be close to the average. So that when I price everything, I'm just going to use that distortion. So on the base, it's what we had before, 115. That gives about $5 of credit or budget for the reinsurance, so fairly close to the TVAR number that we had, and then a sort of walk-away loss ratio for the reinsurance of about 44%. If I increase the mean, the gross premium goes up to 119.6, so about 4% increase. So pretty much in line with the expected loss. You know, a little bit of it's got a little bit more risky, so there's going to be a little bit more of a capital cost in there, so it's a little bit more than the 3%. The net book doesn't really get that much more risky because I'm still attaching my reinsurance at the sort of 90% level. I've taken out a lot of the tail. So 3% increase on the net, but the reinsurance budget is going up 16%. So 16% increase in budget relative to 15% increase in limit, that seems sort of reasonable. And the walkaway loss ratio actually sort of doesn't change to a rounded percentage level point. And then finally, if I overlay the volatility component as well, now I see my premium increases a little bit more, 121 on a gross basis to 5%. My net is 113.8, really no additional change there, because this is sort of, you've got upside and downside going on here, but you are pushing, everything goes out into the tail. So the reinsurance budget is increasing 44% from 5.8 to 7.2, but in line with the increase in limit that you're seeing, okay? So the, and in line with the losses that you're seeing. So in fact, the sort of walkaway ceded loss ratio would actually go down slightly. The company would be relatively more likely to buy reinsurance. So I think it's interesting what the takeaways out of this are that both the mean effect and the variability effect are material, and that they have slightly different impacts on the reinsurance and the net book as we go through. The impact on the sort of desirability of reinsurance not really changing, but is pointing the way to an increase in demand for reinsurance as we face a more uncertain pricing environment going forward. All right, so wrap up. Hopefully, at least a few of you are thinking to yourselves, you know, I should buy a copy of that book and I want to try this when I get back to the office. So what would I be doing to do that? Okay, so the objective here, what I've been talking about, is very much that sort of midsummer planning exercise. You're trying to create some prospective by unit planning pricing benchmarks. Probably you'll express them in terms of combined ratios that you can use with underwriters, your chief underwriting officer, CFO, CEO, to sort of strategically drive the book. You're going to lay them up against the combines that have been achieved by the business units, and you're going to be saying, okay, you know, you're doing great, you should grow. This isn't so fantastic, you know, you should shrink, and, you know, why are we in this business at all? Let's cut it out, right? So it's that sort of strategic level. This will hit the rubber will meet the road in terms of pricing by those combined ratios then being promulgated out to the actuaries as they use sort of, you know, in their deal work towards the end of the year. The inputs that you need for this to work are, you need to have gotten the beans out of the tin. So you do need a tin opener, and you need some by-unit, multivariate, ultimate underwriting outcome distribution, which you're going to get from your capital model, right? I think everyone has to have a capital model, and it should give you this. Whether you need 10,000 simulations or 10 million simulations or whatever, I leave up to you. None of these calculations were done with simulations. I'll be happy to discuss how I did them else time. But you're going to need a lot of simulations. And I notice here I say ultimate, okay? Nobody's mentioned the R word yet about reserves and how we do this, but I would be working this off ultimate losses, and reserves are sort of handled somewhat separately. But your multivariate outcome distribution, if you're saying, oh, this line is riskier because it's long-tailed, well, that should be reflected in its distribution of ultimate losses, because its distribution of ultimate losses is just the sum of the one-year changes in reserves that you get along the way. Okay, you need to make sure that you're consistent there. And then you need your operating plan, which is supporting your valuation. So your CEO, CFO, they're talking to the street, talking to your private investors. How much money do we need to make that supports our price-to-book evaluation? And you've got, you know how much capital you need from a regulatory perspective. A lot of people these days are running pretty close to capital constraint, particularly with the declines in asset values. So these are your two inputs. And then what are you going to do? Firstly, you're going to try and determine how much underwriting income do I need to allocate? Because what we're going to do is, I'm not going to allocate capital. I'm going to directly allocate underwriting income to get direct premiums by unit, premiums net of expenses. So you're going to do that by, you've got your financial model, you know what ROE you may need to make, so you know your after-tax income, you know your pre-tax income, you've got your investment portfolio, investment yields are generally pretty stable, they're much more stable than investment values, so you know how much investment income you're going to anticipate in the coming year. You might have some other service income these days. People have a little bit of that, but generally not too much. The rest has to come from underwriting. Okay, so you can back out of your plan what your underwriting income target needs to be. You're then going to calibrate a bunch of these distortion functions to hit on your total portfolio to hit that underwriting income. So they will price to your required premium that you need to make the underwriting income that you're looking for. And then you're going to use the natural allocation method to allocate that back down to individual units. And then from there, you can derive your target combined load and expenses and what have you. So we're allocating premium directly. We're not going through capital because I at least do not believe, and the market tells you on a daily basis, that not every dollar of capital earns the same return, right? Cat bonds do not earn equity returns. You can see this because you have spreads of 3, 4, 5, 6%. Equity returns 15, 20, 25%. Okay? So you know the cost of capital is not constant, and you know that different lines of business consume different proportions of capital up and down the tower. So different lines of business have different target costs of capital. So basically, knowing an allocated capital number is largely useless because you don't know what target should go against this. But you can compute directly an allocation that's consistent with your total costs, how much each unit should be charged for access to that common pool of capital. And I just think this is a much more productive way of thinking about these problems. And the details are obviously laid out in the book. I was asked at lunch whether I've done this. So I have done this with a fairly large company. And I was quite trepidated because I was banging on, this is a fantastic method, you should try. I've done it in theory, but as we all know, or as someone said, in theory, there's no difference between theory and practice, but in practice there is. And I was worried. I was like, how's this going to turn out when, this could be the end of my engagement with this firm if this is a fiasco. But it worked brilliantly. It worked really well. It came out with much more plausible targets across a pretty broad, I think we had more than 100 buckets that we were allocating to, and it was a very sensible, it passed the smell test as being regarded as a reasonable allocation. And moreover, you probably don't believe me at the moment because I've been yabbering away for so long, but it's actually very straightforward. You can do this in a spreadsheet. It's not that difficult. I mean, if you've got 10 million calculations, you might not be able to do it. If you've got 10,000 simulations, you can definitely do it in a spreadsheet. So. All right, so conclusions. These SRMs are a practical pricing tool. You get a G. I sort of think of the G as it's investors telling management what it thinks of them. It's like a scorecard for them. Some people are going to have more expensive capital. Some people are going to have less expensive capital. Right? There's a reason why certain companies, if you go to their financials, they will tell you their underwriting results every year back to 1986. There's quite a famous E&S company in the US that does this. And it's a fantastic track record. And the reason is this gives investors confidence that they know what they're doing. They're going to get a tight G. They're going to get a low G. But as an actuary on your side, you don't actually know what the investor risk tolerance is. But good news, you can quantify the range. You know that your investor has to be somewhere between here and here, and you can use that to quantify a range of different potential allocations by unit. And at least in the engagement that I was working on, when we looked at that, and there's various other statistics that I haven't shown you that you can use to sort of help choose, there was a general consensus to sort of one end of the spectrum that came out as very, very plausible. And then finally, as you know, this question of the uncertain losses, I think we've got here three material axes of uncertainty. We've got this uncertainty about the risk appetite, and I showed you that that is material in the sense that depending on where you fall on that spectrum, you could decide to buy or not buy reinsurance at realistic market rates. And I think you've seen it with companies deciding to pull back from cat risk, for example. You've got uncertainty about the expected loss, which I think that's a lot of what's going on in the market at the moment, with people talking about, oh, we're getting blitzed with these attritional losses. Well, your attritional loss loads are probably just not high enough. That's why you perceive that you're being blitzed with attritional losses because the loss load isn't big enough. And then thirdly, we've got increase in volatility, which is going to have a leveraged, outsized impact we saw in the example on reinsurers, because it's going to, primary companies are going to want to push that risk up into the reinsurers. It's going to result in a lot of demand for reinsurance, need for extra capital for the industry, but at sort of probably not massively different pricing than we have at the moment. So that's the end of my remarks. I think we are almost at break time. Here's some resources. There's a website for the book. It's got all the case study exhibits. This is all the exhibits for the cat, non-cat, so if you want to see all the things that go through that, I'd be interested to know if you can scan this from the back. This is a Colab Python workbook that will recreate the exhibits that were in this presentation. And then this is my package of software called Aggregate. This is shareware, I'm not selling this. So it's been a labor of love. This is the documentation and the source code. It's on GitHub, and read the docs. And it will do all these calculations. Every calculation in the book was done with this software. So with that, hand it over to Paul.